I've summed up my 5 takeaways and thoughts about this book in this video. I highly recommend you to read the original book of the author. Please share with me your opinion about this book in the comments below. The Intelligent Asset Allocator by William Bernstein is a highly regarded book that provides a comprehensive guide to building an investment portfolio that maximizes returns while minimizing risk. The author, who is a neurologist turned financial advisor, uses his background in statistics and mathematics to explain complex financial concepts in an easy-to-understand manner. The book is divided into 3 parts. The first part covers the history of investing and the development of modern portfolio theory. Bernstein explains the importance of asset allocation, which is the process of dividing your investment portfolio among different asset classes such as stocks, bonds, and real estate. He also discusses the importance of diversification, which means spreading your investments across different companies and industries to reduce risk. The second part of the book focuses on the practical aspects of building an investment portfolio. Bernstein provides detailed instructions on how to determine your risk tolerance and how to choose asset classes that are appropriate for your investment goals. He also explains how to select individual investments within each asset class, including how to evaluate mutual funds and ETFs. The third and final part of the book delves into more advanced topics, such as tax-efficient investing and the use of leverage. Bernstein explains how to minimize the taxes you pay on your investments by using tax-advantaged accounts and investing in tax-efficient funds. He also discusses the use of leverage, which involves borrowing money to invest, and explains how it can be used to boost returns, but also increases risk. Overall, the Intelligent Asset Allocator is an excellent resource for anyone who wants to understand how to build a successful investment portfolio. The book provides clear explanations of complex financial concepts and offers practical advice on how to implement them. Whether you're a novice investor or an experienced professional, you're sure to find valuable insights in this book. Asset allocation is a critical component of building a successful investment portfolio because it allows you to balance risk and reward. The idea is to divide your investments among different asset classes, such as stocks, bonds, and real estate, based on your risk tolerance and investment goals. Each asset class has different characteristics, such as volatility and return potential, so by diversifying your portfolio across multiple asset classes, you can reduce your overall risk and potentially enhance returns. For example, stocks are generally more volatile than bonds, but they also have a higher potential for long-term returns. Bonds, on the other hand, are generally less volatile but have a lower return potential. By combining these 2 asset classes, you can create a portfolio that balances risk and reward. Asset allocation is not a one-size-fits-all approach, and the optimal allocation for each individual will depend on their unique circumstances. Factors such as age, income, and risk tolerance should be taken into account when determining the appropriate asset allocation. A younger investor with a higher risk tolerance may choose to allocate a larger percentage of their portfolio to stocks, while an older investor with a lower risk tolerance may choose to allocate more to bonds. In summary, asset allocation is a critical aspect of building a successful investment portfolio, and by diversifying across different asset classes, investors can balance risk and reward and potentially enhance returns over the long term. Diversification is an important aspect of building a successful investment portfolio because it can help reduce risk. When you invest in only one company or industry, you are exposed to company-specific or industry-specific risks that can lead to significant losses if something goes wrong. Diversification helps to mitigate these risks by spreading your investments across different companies, industries, and asset classes. For example, if you invest all your money in one company, and that company goes bankrupt, you could lose your entire investment. But if you spread your investments across multiple companies and industries, the impact of any single company's failure on your portfolio is reduced. Diversification is not just about investing in different companies or industries, but also about investing in different types of assets, such as stocks, bonds, and real estate. These assets perform differently under different market conditions, and by diversifying across multiple asset classes, you can further reduce your overall risk. While diversification can help reduce risk, it's important to note that it does not eliminate all risk. Even a well-diversified portfolio can still experience losses in a market downturn. However, diversification can help reduce the magnitude of these losses and potentially help your portfolio recover faster. In summary, diversification is an essential tool for reducing risk in your investment portfolio. By spreading your investments across different companies, industries, and asset classes, you can help mitigate the impact of any single company or market event on your portfolio. Point 3 in the Intelligent Asset Allocator by Bernstein is all about selecting individual investments within each asset class. While asset allocation and diversification are critical aspects of building a successful investment portfolio, the specific investments you choose within each asset class can also have a significant impact on your returns. When selecting individual investments, there are several factors you should consider. First, you should evaluate the performance of the investment. Look at its historical returns and compare them to other investments in the same asset class. While past performance is not a guarantee of future results, it can give you an idea of how the investment has performed in different market conditions. Another important factor to consider is fees. Every investment comes with fees, such as management fees, trading costs, and expense ratios. These fees can add up over time and eat into your returns. Therefore, it's important to choose investments with lower fees whenever possible. In addition to performance and fees, you should also evaluate the fund manager's track record. Look at their investment philosophy, their experience, and their overall track record. A skilled fund manager, with a consistent track record of success, is more likely to continue to generate strong returns over the long term. It's important to note that while individual investments within an asset class can have an impact on your returns, asset allocation and diversification are still the most critical aspects of building a successful investment portfolio. Therefore, it's important to choose investments that align with your overall asset allocation strategy and diversification goals. In summary, when selecting individual investments, you should consider factors such as performance, fees, and the fund manager's track record. While these factors can have an impact on your returns, they are not as critical as asset allocation and diversification, which should always be your primary focus when building a successful investment portfolio. Point 4 in the Intelligent Asset Allocator by Bernstein focuses on the concept of rebalancing your portfolio. Rebalancing is the process of periodically adjusting your portfolio to maintain your desired asset allocation. Over time, as different asset classes perform differently, the percentage of your portfolio allocated to each asset class will change. Rebalancing ensures that your portfolio remains aligned with your overall investment strategy and diversification goals. For example, let's say your target asset allocation is 60% stocks and 40% bonds. If stocks have performed well over the past year, your portfolio may now be allocated 70% to stocks and 30% to bonds. To rebalance your portfolio, you would sell some of your stocks and buy more bonds until your portfolio is once again allocated 60% to stocks and 40% to bonds. Rebalancing can be done on a regular schedule, such as quarterly or annually, or when your portfolio has drifted significantly from your target asset allocation. The frequency of rebalancing will depend on your personal preference and investment goals. While rebalancing may seem counterintuitive, as you are selling assets that have performed well, it can actually improve your returns over the long term. By selling assets that have increased in value and buying assets that have decreased in value, you are essentially buying low and selling high, which is the key to successful investing. In summary, rebalancing is an essential tool for maintaining your desired asset allocation and diversification goals. By periodically adjusting your portfolio, you can ensure that you are buying low and selling high, which can potentially enhance your returns over the long term. Point 5 in The Intelligent Asset Allocator by William Bernstein is all about the importance of having a long-term investment perspective. While investing can be exciting and even addicting, it's important to remember that successful investing requires patience and discipline. One of the biggest mistakes investors make is trying to time the market. They try to predict when the market will rise or fall and make investment decisions based on these predictions. However, research has consistently shown that timing the market is extremely difficult, if not impossible. Instead, successful investors focus on their long-term investment goals and stick to their investment strategy, regardless of short-term market fluctuations. Another important aspect of having a long-term investment perspective is avoiding emotional decisions. The stock market is inherently volatile and can experience significant fluctuations in the short term. However, successful investors understand that these fluctuations are a normal part of investing and are able to avoid making emotional decisions based on short-term market movements. Finally, having a long-term investment perspective also requires discipline. It's important to stick to your investment strategy, even during difficult market conditions. This may mean rebalancing your portfolio, sticking to your asset allocation, and avoiding impulsive investment decisions. In summary, having a long-term investment perspective is critical to successful investing. By focusing on your long-term investment goals, avoiding emotional decisions, and maintaining discipline, you can build a successful investment portfolio that generates strong returns over the long term. Thank you for your interest in this book. Please leave your feedback on these thoughts in the comments below, or just put a like on this video. It will help me stay motivated and make more videos like this. In the description of this video, you may find links where you can purchase this book.